Ladies and gentlemen, let me be very clear. Cash is not king in 2026. Cash is lazy. Cash is silent. And cash, sitting idle, is slowly bleeding your purchasing power every single day. Cash loses value every day to inflation. And that's not an opinion, it's math. When you hold cash, you're making a silent decision to accept erosion. You may not see it on your bank statement, but you feel it at the grocery store, in housing costs, in energy bills, and in every service that quietly gets more expensive year after year. Inflation doesn't need to be dramatic to be destructive. Even at modest levels, it compounds relentlessly, shrinking what your money can actually buy. The danger is that cash creates an illusion of safety. The number doesn't go down, so people assume the value is intact. But value and nominal numbers are not the same thing, and confusing the two is one of the most expensive mistakes investors make. Holding cash means you are guaranteed a negative real return when inflation outpaces interest earned. There is no upside scenario. Best case, you lose slowly. Worst case, you lose rapidly. Meanwhile, assets that are productive adjust over time. Businesses raise prices. Real assets reprice. Cash does none of that. It sits there, passive, absorbing the full force of rising costs. That passivity is what makes it dangerous. You are not opting out of risk by holding cash. You are choosing a specific kind of risk, one that is slow, persistent, and unavoidable. People often justify cash by saying they want flexibility, optionality, or peace of mind. Those are emotional arguments, not financial ones. Flexibility only matters if you have a plan to deploy capital and peace of mind is expensive when it costs you purchasing power every single year. Cash feels conservative, but in an inflationary world, it is the most aggressive bet you can make against your own future. You are betting that prices will stop rising, that currency will regain strength, and that time will somehow pause. None of those assumptions hold up in reality. Inflation also compounds the longer you wait. A small annual loss doesn't stay small when it stacks year after year. What feels negligible in 1 year becomes material over 5, 10, or 20 years. This is where long-term damage happens. Retirement timelines stretch. Savings targets move further away. People end up taking bigger risks later to compensate for years of inaction. All of that starts with the belief that doing nothing is neutral. It isn't. Cash also has an opportunity cost that rarely gets discussed. While your money is idle, other capital is working. Businesses are reinvesting. Markets are compounding. Innovation is creating new value. By staying on the sidelines, you're not preserving wealth. You're missing growth that could offset inflation and then some. Over time, that gap becomes impossible to close without taking excessive risk. The discipline of investing early and consistently exists for a reason. Time is the most powerful variable, and cash wastes it. There is a place for cash, but it is narrow and specific. It is meant for transactions, short-term needs, and immediate opportunities, not long-term storage of value. Treating cash as a long-term holding ignores its structural weakness. It was never designed to protect wealth over time. It was designed to move. When you stop it from moving, it decays. The most dangerous part is that inflation punishes patience when that patience is misapplied. Waiting feels responsible, but waiting in cash during inflation is not patience, it's hesitation. And hesitation has a cost that compounds quietly, month after month, year after year, until one day you realize that what once felt like a safe position has left you permanently behind. Cash flow beats idle money because money is meant to move, not sit still. The moment capital stops producing, it starts becoming a liability rather than an asset. Idle money feels safe because it doesn't fluctuate. But stability without productivity is an illusion. What actually matters is not whether your money changes in nominal value, but whether it generates more money over time. Cash flow creates momentum. It turns capital into a system that feeds itself rather than a stagnant pool that slowly evaporates under pressure from inflation, taxes, and opportunity cost. When an investment produces cash flow, it gives you options. You can reinvest it, save it, diversify it, or spend it without touching the original principle. That flexibility is real power. Idle money offers none of that. It just waits. Cash flow, on the other hand, keeps working regardless of market mood. Whether prices rise or fall, income-producing assets continue to generate returns if they are structured properly. That consistency is what builds resilience in a portfolio, especially during uncertain economic periods. Cash flow also imposes discipline. When you invest for income, you're forced to evaluate fundamentals. You look at earnings, margins, sustainability, and balance sheets. You care about whether something can survive, not just whether it might spike in price. This mindset filters out speculation and focuses on durability. Idle cash requires no thinking, no analysis, no accountability. It rewards indecision. Cash flow investing rewards preparation and clarity. There is also a psychological advantage. Receiving regular income changes how investors behave. It reduces panic during volatility because returns are tangible and ongoing. When markets fluctuate, investors who rely solely on asset appreciation tend to react emotionally. Those receiving cash flow are less likely to make impulsive decisions because their investments are already delivering value. Income smooths behavior, and behavior determines long-term outcomes more than market timing ever will. Cash flow compounds in ways that idle money never can. Reinvested income accelerates growth exponentially. Each distribution becomes a new seed that can produce additional income over time. This creates a snowball effect that dwarfs the original capital contribution. Idle money has no such mechanism. It doesn't multiply. It doesn't expand. It simply preserves a number while losing purchasing power behind the scenes. Another critical advantage is that cash flow shortens your dependency on selling assets. If your only strategy is appreciation, you are forced to sell to realize gains. That exposes you to bad timing, unfavorable markets, and tax inefficiencies. Cash flow allows you to extract value without liquidation. You stay invested while still benefiting financially. That separation between ownership and income is what creates longevity in a portfolio. Cash flow also acts as a natural hedge against uncertainty. When interest rates change, policies shift, or markets reprice, income-producing assets often adjust faster than idle cash. Rents rise, dividends increase, contracted revenues reset. These mechanisms help protect real returns. Idle money has no defense. It absorbs every shock directly. Most importantly, cash flow aligns money with purpose. Capital should solve problems, meet needs, and create leverage. Whether it's funding future investments, covering expenses, or building independence, income gives money a job. Idle cash has no assignment. It waits for instruction that often never comes. Over time, that hesitation costs more than any single bad investment ever could. Wealth is not built by accumulation alone, but by circulation. Money that moves through productive systems creates value at every step. Money that sits still becomes weaker, less relevant, and increasingly disconnected from the economy it's meant to serve. Cash flow keeps capital alive, responsive, and engaged in growth, while idle money slowly fades into irrelevance. Quality assets outperform fear-based decisions because fear is reactive and quality is deliberate. When investors act out of fear, they prioritize short-term comfort over long-term results. They chase certainty in uncertain environments, often retreating into cash or low-yield instruments. That feels safe, but fail to protect purchasing power or generate meaningful returns. Quality assets, by contrast, are selected through analysis, patience, and discipline. They are built to endure volatility rather than avoid it, and that endurance is what creates outperformance over time. Fear-based decisions usually emerge during periods of market stress where headlines are loud and narratives are emotional. In those moments, prices reflect panic more than fundamentals. Investors who sell simply to escape discomfort often lock in losses and miss recoveries that follow. Quality assets don't rely on perfect conditions to perform. Strong businesses, durable real assets, and well-structured investments continue. to operate, generate revenue, and adapt even when sentiment is negative. Their value is not dictated by daily mood swings, but by their ability to function in the real economy. Quality is rooted in fundamentals. It shows up in strong balance sheets, consistent cash generation, defensible market positions, and competent management. These characteristics allow assets to survive shocks and emerge stronger when weaker competitors fail. Fear ignores these details. It compresses decision-making into a binary choice of fight or flight. That simplification leads to poor timing and shallow analysis. Quality demands the opposite approach, understanding what you own and why you own it, regardless of noise. There is also a compounding advantage to owning quality. High-quality assets attract capital, talent, and opportunity. They reinvest profits more effectively, expand intelligently, and protect margins over time. Even during downturns, they are often in a position to acquire distressed competitors or strengthen their market share. Fear-based decisions remove you from that process entirely. By stepping aside, you forfeit the upside that comes from resilience and strategic patience. Another critical factor is behavior. Investors who anchor their strategy to quality are less likely to overtrade. They are not constantly reacting to price movements or media cycles. This reduces transaction costs, tax drag, and emotional fatigue. Fear-driven investors tend to do the opposite. They move in and out, trying to predict short-term outcomes, often buying high and selling low. Over time, this behavior erodes returns far more than any single market downturn ever could. Quality assets also provide optionality because they maintain value and liquidity. They can be leveraged, refinanced, or repositioned when opportunities arise. They give you choices. Fear-based decisions narrow your options. When you exit markets or retreat entirely, you lose strategic flexibility. Re-entry becomes harder psychologically and financially, especially if prices recover faster than expected. The long-term record consistently shows that markets reward durability, not panic. Every cycle has moments of fear, and every cycle eventually moves forward. Those who remain invested in quality participate in recoveries and expansions. Those who flee are left watching from the sidelines, waiting for certainty that never fully arrives. Fear demands perfect clarity before action, but quality investing accepts uncertainty as a constant and focuses on what can be controlled. In the end, investing is less about predicting events and more about positioning for outcomes. Quality assets are positioned to benefit from growth, withstand stress, and adapt to change. Fear-based decisions are designed to avoid pain, not to create progress. Avoiding pain may feel rational in the moment, but over time it leads to stagnation, missed compounding, and regret. The investors who outperform are not the ones who feel the least fear, but the ones who refuse to let fear dictate. Their choice's pricing power protects portfolios because it determines who absorbs rising costs in an economy that never stands still. When inflation, supply shocks, labor expenses, or regulatory burdens increase, someone has to pay. Companies and assets with pricing power can pass those costs onto customers without destroying demand. Those without it are forced to absorb the hit in their margins, slowly weakening their financial position. Over time, this difference compounds into a massive gap in performance, stability, and survival. Pricing power is not about greed or arbitrary price hikes. It comes from necessity, differentiation, and trust. When a product or service is essential, hard to replace, or meaningful, better than alternatives, customers tolerate higher prices. This creates a buffer between external pressures and internal profitability. In contrast, businesses competing purely on price have no defense. The moment costs rise, they are trapped. They either raise prices and lose customers or hold prices steady and bleed internally. From an investor's perspective, pricing power is one of the most reliable indicators of long-term strength. It signals control over revenue rather than dependence on volume. Companies with this advantage don't need perfect conditions to perform. They can operate across cycles, adjusting prices incrementally while maintaining demand. This adaptability stabilizes cash flow, supports dividends, and protects balance sheets during volatile periods. Assets without pricing power experience earnings compression at the worst possible times, exactly when resilience is needed most. Pricing power also aligns closely with brand strength and market position. Strong brands reduce sensitivity to price changes because customers associate them with quality, reliability, or status. Network effects, switching costs, and regulatory barriers reinforce this advantage. These factors create moats that competitors struggle to cross. When inflation rises, these businesses don't scramble. They adjust. That calm response is what separates durable investments from fragile ones. Portfolios benefit from pricing power because it reduces dependency on macro forecasts. You don't need to predict interest rates, commodity cycles, or policy shifts with precision. Assets that can reprice themselves act as internal hedges. They respond dynamically to economic pressure instead of waiting for external relief. This makes them especially valuable in uncertain environments where traditional correlations break down and volatility increases. Another overlooked benefit is predictability. Pricing power supports more consistent earnings, which improves valuation stability. Investors are willing to pay premiums for businesses that can maintain margins across cycles. That premium itself becomes a form of protection, as these assets tend to experience smaller drawdowns during market stress and recover faster afterward. Weak pricing power leads to earnings surprises in the wrong direction, eroding confidence and compressing valuations. Pricing power also enhances capital allocation. When margins are protected, management can reinvest confidently, fund innovation, and pursue strategic growth without compromising financial health. This creates a positive feedback loop where strength begets strength. Businesses under margin pressure are forced into defensive decisions, cutting investment, delaying upgrades, and weakening their competitive position over time. In real assets, pricing power shows up through contractual structures and scarcity. Rent escalations, long-term agreements, and limited supply allow income to adjust upward over time. Assets lacking these features fall behind as costs rise faster than revenue. The same principle applies across asset classes. The ability to reprice is the difference between keeping pace with inflation and falling permanently behind it. Ultimately, pricing power is a form of control in a system defined by constant change. It determines who dictates terms and who reacts to them. In an environment where costs rise unpredictably, control is the most valuable asset an investor can own. Portfolios built around pricing power are not immune to volatility, but they are far better equipped to absorb it, adapt to it, and continue functioning. While weaker assets struggle to keep up, diversification is survival, not comfort. Because markets do not reward certainty, they punish overconfidence. When a portfolio is built around a single idea, asset, sector, or outcome, it becomes vulnerable to forces that are impossible to predict or control. Economic shifts, policy changes, technological disruption, geopolitical events, and market sentiment can all change direction faster than any individual investor can react. Diversification is not about smoothing emotions or reducing boredom in a portfolio. It is about reducing the probability of permanent damage. Concentration assumes the future will behave in a familiar way. Diversification assumes it won't. History consistently favors the second assumption. Entire industries that once dominated markets have faded or collapsed. Geographic regions rise and fall. Asset classes rotate in and out of favor. A diversified portfolio accepts that leadership changes and prepares for it in advance. Survival depends on adaptability, not conviction. Many investors resist diversification because it feels like dilution. They believe spreading capital reduces upside. That belief confuses optimization with fragility. Maximum upside only exists if nothing goes wrong. Diversification exists because things do go wrong. It ensures that when one part of the portfolio underperforms or fails, it does not take everything else with it. The goal is not to avoid losses entirely, but to ensure losses remain recoverable. Diversification also protects against the risks investors underestimate the most. These are not daily price fluctuations, but regime changes. Inflation replacing deflation. Rising rates replacing low rates. Regulation replacing deregulation. Innovation replacing incumbents. Concentrated portfolios are exposed to regime risk. Diversified portfolios are built to function across multiple environments, even if none of them perform perfectly in any single one. There is a psychological advantage as well. When all capital is tied to one thesis, every data point becomes emotionally charged. Investors begin to defend positions instead of evaluating them objectively. Diversification lowers emotional attachment. It creates distance between identity and investment. That distance improves decision-making and reduces the likelihood of panic selling or stubbornly holding failing positions too long. Diversification also increases longevity. Investing is not a short-term competition. It is a long-term process of staying solvent, disciplined, and engaged. Portfolios that experience extreme volatility or catastrophic loss often force investors out of the market entirely. Survival is not glamorous, but it is essential. You cannot benefit from long-term compounding if you are forced to exit early due to poor structure. Effective diversification is intentional, not random. It is based on how assets respond to different economic pressures. Assets should behave differently under stress. Growth, inflation, deflation, and tightening conditions. Owning multiple assets that move together offers the illusion of diversification without the benefit. True diversification spreads exposure across uncorrelated or differently correlated drivers of return. Another benefit is optionality. Diversified portfolios naturally create opportunities for rebalancing. When some assets outperform while others lag, capital can be redeployed without adding new money or increasing overall risk. This internal recycling of capital improves long-term efficiency and reduces reliance on external timing. Diversification does not eliminate risk, it manages it. It accepts that uncertainty is permanent and prepares accordingly. Comfort comes from believing you are right. Survival comes from accepting you might be wrong. Portfolios built for comfort collapse when reality changes. Portfolios built for survival remain standing long enough to adapt, recover, and continue compounding while others are forced. Out of the game cash is a tool, not a strategy, because strategy implies direction, intent, and an expected outcome. Cash by itself has none of those qualities. It does not grow, adapt, or respond to changing conditions. It simply exists as a medium of exchange. Treating cash as a long-term plan is like treating a parked vehicle as a journey. It may feel secure, but it isn't taking you anywhere. Tools are meant to be used, not admired, and cash only becomes valuable when it is deployed with purpose. The misconception around cash comes from its simplicity. It is easy to understand, easy to access, and easy to measure. There's comfort in seeing a stable number that doesn't fluctuate. But stability without productivity is not safety, it is stagnation. A strategy requires assets that respond to time, effort, and economic growth. Cash does the opposite. Over time, it becomes less capable, less powerful, and less relevant in an expanding economy. Cash has a role, but that role is narrow. It exists to facilitate transactions, manage short-term obligations, and provide flexibility for opportunities. Beyond that, it becomes inefficient. Holding excessive cash for long periods reflects indecision rather than prudence. It often signals fear of making the wrong move rather than confidence in a well-constructed plan. A real strategy acknowledges uncertainty and still acts within it. Another danger of treating cash as a strategy is missed compounding. Compounding does not work in isolation. It requires participation. Assets that generate income reinvest profits, or appreciate through productivity harness time as an ally. Cash wastes time. Every year it remains idle is a year lost to growth that cannot be recovered. Waiting for perfect conditions rarely results in action, and the cost of waiting compounds silently. Cash also creates a false sense of control. Investors believe they can deploy it at the right moment, but those moments are only obvious in hindsight. Markets move before consensus forms. By the time certainty appears, opportunities are often repriced. A strategy is not about perfect timing. It is about consistent positioning. Cash held indefinitely avoids risk, but also avoids progress. When volatility increases, cash feels like protection. In reality, it is only a pause. Without a framework for redeployment, pauses turn into paralysis. Investors sit on the sidelines, watching conditions change, narratives shift, and prices move away from them. Strategy anticipates volatility and plans around it. Cash simply waits and hopes. Cash is also reactive by nature. It does nothing until acted upon. Productive assets, on the other hand, are proactive. They generate income, adjust pricing, reinvest capital, and respond to economic forces without constant intervention. A strategy should reduce dependence on constant decision-making, not increase it. Cash requires perpetual judgment calls about when to act, creating friction and hesitation. Using cash correctly means assigning it a job. Emergency reserves, near-term expenses, and tactical opportunities justify holding it. Beyond those purposes, cash should transition into assets aligned with long-term objectives. Strategy connects capital to outcomes. It answers why money is allocated, how it works, and what role it plays over time. The most effective portfolios treat cash as a supporting element, not a foundation. It lubricates movement but does not drive results. When cash becomes the centerpiece, progress stalls. Strategy demands engagement with risk, growth, and uncertainty in measured ways. Cash gives you the ability to act, but only strategy tells you when and why. Without strategy, cash is idle potential. With strategy, cash becomes a starting point rather than a destination. The difference determines whether capital merely exists or actually works.